So I know what you're thinking. It's been 2 hours of presentations. This is the 2 to 2.5 hours of presentations of mostly male people on stage talking about payments. So it's getting to be a bit of a long morning, but don't worry, hang in there. We can do it. It's only 30 minutes left. I will try to keep you as entertained as possible, even though the odds are kind of against you. Ultimately, you're looking at a gray-bearded guy from an incumbent bank talking about future payment stuff, so it's not looking great. The other bad news for you, of course, is that I actually did some effort. So I put some nice animations and videos into my presentation coming in this morning, and none of it works. So it's all gone. So it's going to be just static slides, and I will try to explain through them with this fairly two-dimensional technology. Let's put it that way. Everybody on this stage has introduced themselves, so I will do the same. My name is Ville Sointu, as you can see up there on the slide. My main job, or my day job at Nordea, is to be responsible for digital currencies, which is a little bit ironic, of course, because if you are a customer of Nordea, you will know that we have nothing to do with digital currencies today. But that's a good thing, because I'm also fairly focused on future things rather than the things that happen today necessarily. So I'm responsible for digital currencies and the way these will be embedded into our society and from a Nordea's perspective into our systems in the future. As you will learn soon from the presentation, there's basically two ways digital currencies will become reality. Number one is that there is a clear demand from the customers. There's clear demand from the society, from the digital transactions that we do, that we need something different that doesn't work with today's methods. This is largely absent today. That's a bit of a spoiler for you. And then we will learn that the second way of getting digital currencies into reality is to force them into reality. And that's exactly what's happening with the digital euro. So I will talk about the digital euro, even though that will not be the focus of my presentation. I will mention digital euro as in the context of digital currencies, and I will try my best to explain what does that mean for us as customers of banks here in Finland in the future, and what obstacles we might be facing when it comes to the possible adoption of the digital euros and central bank digital currencies in general. But because I work for a bank, we're big on risk management and hedging risk, as we learned today from the other presentations as well. And due to that, I do need to make two notes on the content of today's presentation. Like I said, the focus will be on digital currencies, and I'm happy to talk about the digital euro as well, but I will try to answer the question, why do we need them, and what are the things we need to look at when we are dealing with digital currencies in order to understand how they differ from the digital money that we have today. Because remember, practically all the money we use today is already digital. There's nothing really that we do today with anything else than digital money. So what is a digital currency? I will try to answer that question. The second disclaimer that I have to have is that this is the fourth time I'm using these same slides. So if you're in the audience and you've seen me speak somewhere, you will probably recognize some of these slides. But I have given myself a New Year's promise that the fourth time is the maximum I will use these slides. So next time I will see you, I will have some new content. So again, with that being said, and all the risks being hedged to the best of my ability, let's get along with it. The title of my presentation was Blueprint for Digital Currencies from a banker's perspective. I thought that let's get that whole blueprint thing out of the way on the first slide so that I can focus on complaining for the rest of the presentation why nothing actually works. So the blueprint of the digital currency space is, as we see, based on three different dimensions. This was one of these funny animated slides, so I would have been able to talk about this in order, but again, let's try to pick this with one by one. In any transactional ecosystem, there's, again, three main pillars that we need to examine. And this is not only for digital currencies, this is for any transactional system, including the ones we have today. E-money systems, banking payment systems, everything is based on these same three pillars. First one is value. In order to transact with value, you need to have a clear definition and an agreement, indeed a contract, about what is value. How is that calculated in the economy around you, not only in the ecosystem where you're transacting? How do you transact with value? This is a fundamental building block of any transaction system by definition, of course. But if we examine this value question through the lens of what we have today, we can see, for example, that the money you have in your Nordea bank account, the euros, the dollars, other currencies that you might have, that you can spend. You can use them in different ways, and it will be generally accepted as a means of payment and a form of value by other parties in the digital payment ecosystem. If you, however, take any form of unregulated or under-regulated liabilities into this play, it becomes a little bit more nuanced picture. For instance, the cryptocurrency space, bitcoins, all of that, they are basically not based on anything. They're not actual liabilities. They're not really applicable for payments. They are just imagination from between the users of that system. Now, of course, imagination is a very powerful thing, as we will learn later on in the presentation, and we will talk about that. But the practical reality is still the same. You cannot really use anything else except regulated forms of money in order to transact in the economy today. So again, whose liability is this thing that you have in your account? The token, the ledger, so again, who is the liability of what you have in your account, in your ledger, in your token? You need to be able to exchange it for something. That is a critical question, number one, around value. The second part is identity, and this is a somewhat misunderstood concept as well. In order to be able to transact in a legal way, and in order to be able to create contracts, payment contracts between parties, you need to have legal signing rights. This means that there needs to be a strong identity available for digital transactions in any ecosystem. That's why we have KYC, know your customer processes today. That's why we have strong customer authentication. That's why we identify ourselves whenever we transact with digital value. As much as you would like to believe the crypto lunatics out there, you do need identity in every transaction that you do in the digital ecosystems. This is because that's the way the laws are done. There's no way you can do today legal transactions and be compliant without a form of digital identity when you transact. The absence of this and the pseudonymity of many of these crypto networks makes it by definition not compliant with the laws and regulations that we have today. So this is something that we have to take into account when we talk about digital currencies as well. When we have digital currencies, it cannot be unbundled from identities. Good thing to remind as well is that even though identity needs to be embedded in the payment transaction, it doesn't mean that every transaction will be completely public, or you're able to that some party is able to survey you. No, it's anonymous is different from private. Privacy preserving technologies can be used in a way that we have a strong identity present in digital transactions as well. The third one, and this is the part where the digital currencies are, well, at least proclaiming that they have a difference to make, and that's networks. Where can you use this value? Where is it applicable? Where can you use it? Can you transfer it to other parties? Do you need to know the other party? Does the other party need to be a part of the same network or same system as you are? This is the key question. Today, if you and me are Nordea customers, we can transact so-called on us. The network is the Nordea network. So again, on us transactions are very easy to do. Again, we are all known by the same party. We do the transactions there. It gets a little bit more complicated, as we know, as you move further away from the same system. So when my friends are at OP Bank, we need a network that connects Nordea Bank and OP Bank together, and there needs to be clear rules on how does actually value move between those nodes. These are the traditional payment networks that we have today, the SWIFTs, Visas, MasterCards, and others, even though technically they're not payment networks. But nonetheless, the information exchange and the rules related to the legal liabilities when transfer of value happens between these entities is the way it's done today. The digital currency space tries to answer the question, how can we create interoperable value so that we're able to transact in these ecosystems in a much more scalable way? Is there a way where we can create a network between entities holding identities and then transact with trust and legal liabilities? The breadth of or the size of these networks really is one definition of how powerful a new digital currency can be. So, with this in mind, let's look at the dimensions of some of the current systems that we have today. For example, I'm a Revolut customer. Revolut has an e-money license and a banking license. It's a fantastic way of moving value between Revolut users instantly with clear liabilities and everything related to that. If I want to move money from Revolut to Nordea, we need to external raise like SEPA Instant in order to send that money. And again, it becomes a more complex scenario. If I have a digital currency that is a liability of some party, and there is a legal definition of that digital currency, then I'm able to transact with any participant of the network without necessarily knowing where it's going. I'm able to embed a legal signature around that transaction, and that makes it also compliant with the rules and regulations. The digital currency landscape as we see today. Again, this is a busy slide that I would have wanted to have animations, but apparently not today. So we start from the bottom. Like I said in the very beginning, the digital currency itself is never a justification to do anything in this space. When we look at digital currencies, we only see them as a means to an end to provide some kind of value to our customers. And we always start from business use case. You could also say that that is the end customer value that needs to be obtained in order to justify any participation in a digital currency network of one type or another. The second is the network. Sometimes this is where the whole conversation around digital currencies gets stuck, because some companies especially, they like to come and talk to us about, this is the fantastic new digital currency that we have developed. We issue it, we run it, but we have no participants, so the network doesn't exist. And because the network doesn't exist, then there's also no business use case. The parties in that network are not able to transact with each other because, again, there is no business use case to do that. So the chicken and the egg problem is very, very real. How do you create the connections in order to justify investments into business use cases when, when you don't have the business use case? So again, cracking this problem has always been a bit of an issue. It still remains an issue today. I have divided the digital currency landscape into 4 different pillars. And roughly speaking, we have public versions of digital currency and private versions of digital currency. The Starting from the private side of digital currency space. The number one, and this gets a little bit technical, so I am sorry about being the last presenter and going a little bit technical, but here we go anyway, is the first version is a tokenized deposit. This means that we have deposits in typically commercial banks. So again, a regular account in a regular bank, and then we issue tokens into a network, permissioned network or a closed network, based on the value that sits on that account. Bear in mind, this is exactly, by the way, how e-money systems work. E-money systems today, e-money institutions as we have today, they work exactly like this. They have pool accounts in regular bank accounts, and then they have the ledger between different users on their system. But technically, all the money that is the equivalent of the money in the e-money system sits in a regular bank account in commercial banks. Now, the only difference between tokenized deposit and that is that there is a distributed ledger network where tokens move between these nodes. But the total value of all that money in that network equals to the money in the pool accounts in the participating banks. So what happens is that you're able to create this network where you're able to do instant transactions between parties in that network. And then at the end of the day, you will basically reconcile and settle between the actual bank accounts around that network. It raises the question, why do we need a distributed network to do that? Is there something unique or specific that can be done with this type of network compared to just having a central database in the middle where we all agree on the rules? And the answer is, as far as I can see it today, no, there's no difference there. The actual difference is around governance, not technology. Payments, as you will learn, is not about technology. The second form of private digital currency is so-called stable coins and e-money tokens. The only difference to what I just explained about the tokenized deposits is that the network where these tokens are being issued are permissionless networks. So this means the public blockchains, the Ethereums, the Solanas of the world, where governance is more loose, more distributed, if you will. This is problematic, to say the least. As a bank, we need to identify all counterparties when it comes to transacting with value that sits on our balance sheet, and that means that many of the networks are not actually compliant with this requirement. Yes, there are ways to do that, but that also raises the question: well, why? Why do we need to do this? We haven't been able to identify a single good reason to issue stable coins on a public ledger that is not related to degenerate gambling. The third version of digital currency, and this is actually starts to get quite interesting, is the wholesale central bank digital currency. So central bank digital currencies typically are divided between two flavors, if you will, of CBDC. Number one, wholesale; second, retail. Wholesale central bank digital currency is central bank liabilities that are exchanged between legal entities, companies, and institutions that have access to central bank settlement and clearing. As opposed to that, the retail version of a central bank digital currency is like the digital euro, where individual citizens are able to have access to direct central bank liabilities, exactly as it is with cash. I will go a little bit deeper into the wholesale CBDC question on the next slide, but I will now spend a few minutes talking about the retail CBDC case through the lens of the digital euro. The digital euro at the moment is being prepared by the European Central Bank. The current schedule, the official schedule, says that we will have potentially digital euros in our hands in 2029 at the earliest. The schedule, of course, lives because it's a highly political process, but again, the official communication is at 2029. Now, what does that mean? In 2029, when we have a fantastic digital euro account in our mobile banking application, what does that actually mean? The most significant difference for you as a citizen are the follows. The reasons are as follows. First of all, it is a direct central bank liability. So today, if you want to have a central bank liability in your pocket, that means that you have to go to an ATM and get physical cash. That is between you and the central bank. You're not in connection with your bank anymore with that banknote that you have in your pocket. There is no digital version of that today. So the digital euro seeks to be exactly that. So the money you have in the Nordea bank account, that is a liability of Nordea. So again, you trust Nordea to be a stable institution that takes care of your money, and then you will be able to transact with value. But there is no direct central bank connection in there. The digital euro will change this. So it will make it possible for you to have a separate account at banks and other payment service providers, that you're able to move money from your commercial bank account into the digital euro account. And that becomes a liability of the central bank. From the bank's perspective, this, of course, is problematic because it moves away from the balance sheet of the bank at that point in time. And as we know, in fractional reserve banking, if you don't have enough central bank assets on your balance sheet, that will directly impact your ability to provide credit to your customers. Again, this is a discussion about the financial stability and the macroeconomics of the digital euro. But from a consumer standpoint, fantastic. Now I have a central bank liability in my mobile banking application. This brings us to the second part that will be different from the of value potentially to use of the digital euro, which is that they will mandate acceptance of the digital euro. They are planning to have a legal tender status for the digital euro, which means that not only is it always you're able to settle any contractual obligation with the digital euro, and every institution needs to be able to do that, but also from a day-to-day perspective, every merchant, every point of sale that has the ability to accept the digital payments will need to accept digital euro payments. This will be a third rail, a new payment scheme. That means that it will not use MasterCard, Visa, any other rails. It will be its own scheme. In fact, it's going to be not only its own NFC QR code capabilities, but it also have a separate physical card coming with it. So again, it's universal acceptance across the Eurozone. Third difference from what we have today is that across the Eurozone, you will have the ability to transact in real time, person to person, with anybody in the Eurozone. You don't need to know anything else except the phone number or other identifier of the recipient. You don't need to know which bank they're using. You don't need to know which app they're using. All you need to know is this identifier, and you're able to send money instantly to another Eurozone citizen. And practically, that's it. Now, we can argue whether or not these are enough from a consumer standpoint to justify the gigantic investments that will need to go towards actually making this happen. I will not start to talk too much about the cost, but if you just put together what I just told, a new payment scheme, universal acceptance, real-time P2P across the Eurozone in all service points and touch points, and commercial banks being liable for all the usual regulation when it comes to these transactions, you can probably guess that it's not going to be cheap for banks to implement this. The rationale for doing this is still under conversation. This is part of the political process of the digital euro, and we will, of course, continue to follow this discussion to the best of our ability. Good. I could go on about the digital euro for hours, so let's try to move on a little bit. Quick one to the wholesale part of the digital currency space, or CBDCs, is effectively, again, the ECB has correctly pointed out that at the moment, there is really no reason to do a wholesale CBDC because central bank money already settles instantly. Target 2 and TIPS are very effective ways of doing this. So the question becomes, do we need to open it up for other types of participants in order to make it more efficient to transact with these new ecosystems? The test that the European Central Bank is doing is they're putting forward 4 different models of doing a wholesale CBDC. Number 1, do nothing. Basically, just open up an API and let them settle. That actually caters for 95% of the demands in the wholesale CBDC space. The 3 other models, and I will not get into the technical details here today, but they are different levels of tokenization and participation in these DLT networks on behalf of the European central banks. These experiments started beginning of last year, and they are ongoing as we speak. We will see and get the reports fairly soon on how actually this will work. The core use case is so-called delivery versus payment or payment versus payments. In the securities settlement systems, this means that you're able to get recognized for the transaction immediately as soon as the securities transaction is completed. For those who work in capital markets, you will probably know that that actually is quite valuable use case. This is my favorite topic, and I will try to wrap up gradually on this. Is that one of the things that you will hear from the blockchain advocates and all other advocates of digital currencies is that these new digital currencies are fantastic because they are programmable. They are programmable money. Well, as we have already established, all money except physical cash is already digital. That means all digital money is also programmable. So what is the difference that we're talking about then? Well, the only question is programmable by who? Who gets to define those rules between transacting parties? Where is that logic executed? And who is liable for the end result of those quote unquote programmable transactions? There's nothing in terms of technology that we couldn't do today in the existing systems. I mean, we already have so many quote unquote programmable use cases in the way we transact today. And there's nothing that these new blockchains and tokens that will bring into this world, except if the networks that run this logic are such that identity and value recognition is done in a correct way, we're able to create an environment where logic can be run in a mutually agreed way, and most importantly, legally binding way. This is not reality in practically all of the quote-unquote blockchain type of networks today, and that's what we're observing. That's what we're trying to get done as well from our perspective in a bank, even though we're not seeing it like that. The other angle of where we see the evolution of towards more conditional payments rather than programmable money that we see it is through embedded finance. Embedded finance is another topic of itself, but we will see more and more value transactions being embedded into the customer journeys in different digital processes where you don't need to actually go to the bank to do the actual transaction. Keep your eyes on embedded finance is what I'm trying to say. Now, I see that I'm already running out of time, so I'm going to skip the part where I was going to trash the crypto space. So if you're interested in the reasons why cryptocurrencies are bad, I can do that over coffee later. But let's quickly just run through these slides as pictures. Basically, it's problematic for all the reasons that I just explained, and they really don't work. The final slide, and this is a great example of why crypto actually isn't that fantastic, is because anybody is able to create their own quote-unquote cryptocurrency today. We had a glimmer of hope some years ago when FTX fraud happened. That meant that there was an adequate amount of criticism towards these actors in the crypto world, and the attention was being shifted towards okay, we actually need to question these people who are working in these ecosystems. The explanation just cannot always be, well, we do it because blockchain. So again, blockchain or not, you're still dealing with people. You're still dealing with their own interests. You're still dealing with the absence of trust that you have towards this. Blockchain doesn't create trust. The unfortunate fact then, of course, is that now we're seeing the rise of these meme coins. I think there was in Helsinki Sanomat yesterday, there was an article about these meme coins that described them as uh, a toxic combination of pyramid schemes and gambling. And I think that is a very accurately said, not my quote, so you could say Helsinki Sanomat who said that. So and the reason is because, again, you create these tokens out of nothing, people buy them, then the only way for you to get out of that is to find another person to get that off your hands. There's no value creation. And of course, now we have the Trump coin, which raised like 25,000%, I think, in a day. And it's quite unlikely that Donald Trump will regulate his own coin in the future. So we're in for an interesting couple of years here for sure when it comes to crypto regulation. All I'm trying to say that we as banks are still extremely skeptical of this space, and we're doing our best to keep everybody safe. So the future of money is what we make of it, but it's also the future of money is what we deserve. So let's make sure that we deserve a better future for our money in short. That being said, I want to thank you. I'm out of time. I'm also, in addition to being working at Nordea during daytime, in my free time, I'm co-hosting the FinTech Daydream podcast together with Paul from Sumlink. And of course, we have Janne from Helsinki FinTech Farm here as a regular co-host of the podcast as well. Check us out. We have plenty of opinions also on crypto. All right. Thank you.